Hello. This video gives definition to the major lines in the balance sheet of agricultural equipment dealers, in duration of 10 minutes. It is part of financial training for non-financial territory managers, working for producers of agricultural equipment. Balance sheet summarizes what is owned by the company, what is owed by the company, and how much is invested by the company owners. Balance sheet helps to evaluate an overall financial position of a company, and its ability to meet its operating needs. Like an example with an athlete. Knowing weight, height, age, experience, and other physical measurements of an athlete, we can assume how fast he would run short distances, and if he is able to accomplish marathon. Profit and loss report shows results of the dealer operational activities. Profit and loss report explains if the company is good in sales, and if the operational activities are conducted efficiently. Similar to the example with an athlete, P&L shows if the athlete was actually successful running the short distance or marathon. These reports are connected with each other. Let's take a look on how they are connected. First of all, let's define what is profit. For many people, a profit is something that is left in bank account at the end of the month, when all purchases are made and bills are paid. That's how some people define profit. Many companies define profit the same way, but it is wrong definition, especially when it comes to companies. Let's look at some simple example. Imagine your neighbor borrowed $20 from you. In this moment, his balance sheet changed following way. On assets side, money in the pocket equals $20. And on liability side, borrowed from neighbor equals $20 too. Later, he purchased an apple pie for the price of $10. His balance sheet changed again in following way. Money in the pocket equals $10. Apple pie in the fridge equals $10. Borrowed from neighbor, from you, $20. Then, he cuts the pie into 5 equal pieces. He eats one piece of the pie, as the price of apple pie was $10, and one piece is gone. The balance sheet changed following way. Cost of the remaining pie reduced, and now equals $8. The total assets also reduced to $18. There is new section in liabilities. It is called retained losses. It equals $2, shown in negative number. Borrowings remain the same, $20. Total liabilities, $18, equal to assets. Please remember main accounting equation. Assets are always equal to liabilities. Then, your neighbor managed to sell one piece of pie to another neighbor. This another neighbor was hungry and lazy, so he decided to skip going to corner shop, and preferred to buy this piece of pie for $5. The balance sheet changed following way. Money in the pocket increased, plus $5, and equals to $15. Cost of the pie is reduced by $2, and now equals to $6. Cost of the 2 pieces of pie that are now gone, plus revenue from the deal, resulted in retained earnings of $1, reflected in liabilities section of the balance sheet. Both assets and liabilities increased, and are equal, $21. The borrowings remain unchanged, and equal, $20. So, in the end, there is balance sheet that describes your neighbor's assets and liabilities, and profit and loss report describing results of his operational activities. Because of these activities, he was able to increase his assets up to $21 and generate profit of $1. In worst-case scenario, your neighbor sells piece of apple pie on credit. By this, he opens new line in the balance sheet. The line is called accounts receivable. Accounts receivable would equal to $5. In even worser scenario, your neighbor gets oversatisfied with his P&L. He decides to take the profit of $1 out of the business as his dividends. In this case, balance sheet assets and liabilities decreased to $20. In theory, you see good-looking profit and loss results. In fact, there is less actual money in his business. It also may mean there are less chances that you will get your $20 back. This example shows how a balance sheet and a profit and loss reports are formed and connected to each other. These reports help us to see full picture about the company. Based on that information, we can make informed decisions. Let's talk about a balance sheet in more details. A balance sheet consists of assets and liabilities. Assets show everything that has money value and owned by the company or under the company control and expected to provide future benefits to the company. Liabilities are obligations not yet completed or paid for. Usually, these obligations are defined by previous business transactions, events, sales, exchange of assets or services, or anything that would provide economic benefit at a later date. Let's talk about assets in details. As we said before, assets are things owned by the company. However, there are items that are in operating lease. These items are not reflected in the company balance sheet. Assets are classified and grouped in accordance with their level of liquidity. Liquidity measures how fast an asset can be turned into cash without losing its initial price. Short-term assets turn into cash in duration of less than 12 months. Short-term assets, usually reflected in dealer balance sheet, include cash, accounts receivable, and inventory for sales. Long-term assets are used by the company for many years. They include things like land, buildings, equipment, vehicles, and other valuable items. Long-term assets are not for resale. They stay in dealer balance sheet for a period of more than 12 months. There are many groups of assets that can be found in dealer balance sheet. In this video we will cover only a few of them, which we find as most important ones. Inventory. Inventory line in dealer balance sheet shows cost of goods purchased by dealer for resale. Dealer inventory usually consists of following groups. New equipment. Rental equipment for resale. Demo equipment for resale. Pull type equipment and attachments. Used equipment. Parts. Cost, at which inventory is reflected in balance sheet, is called book value. Book value includes following elements: dealer net purchase price, service hours for pre-delivery inspection, cost of additional parts, attachments used, and service hours associated with the unit. Accounts receivable. Accounts receivable reflect everything that is owed to the company. Accounts receivable increase when something is sold on credit, and decrease when credit is paid back. Here are several examples of accounts receivable: sales on credit, prepayments to suppliers, accrued warranty claims, accrued supplier bonus, employee advances paid, and other items. Fixed assets. Fixed assets are not purchased for resale. Duration of their life in dealer business is more than 12 months. Following are fixed assets that usually can be found in dealer balance sheet: land and buildings, equipment and furniture, computer hardware and software, vehicles, equipment for rent, not for resale. When dealer purchase fixed assets, he doesn't immediately write costs off to expenses. These costs turn into expenses, step by step, during whole time the asset is used by dealer. This process is called depreciation. All fixed assets, except land, are depreciated. Step by step, depreciation decreases asset value in the balance sheet. If the asset is in operational lease, usually this type of assets are not reflected in the balance sheet and are not depreciated. In this case, periodic rent payments just go straight to expenses. And again, land is never depreciated. There are different methods of depreciation, but we will not cover these in this training. Liabilities and owner's equity. Liabilities are everything that dealer owes to third parties. Similarly to assets, liabilities can be short-term or long-term. Short-term liabilities should be paid back in duration of next 12 months. We will cover following groups of short-term liabilities. Short-term loans. Accounts payable. Accounts payable are obligations of the dealer to pay a creditor by the terms agreed upon by said creditor. Accounts payable is very important resource of dealer financing. Dealers delay payments of accounts payable. Simultaneously, dealers aggressively demand payments from debtors. This helps to increase levels of cash needed to purchase more inventory and cover immediate operating costs. Short-term loans. Dealers require significant volumes of working capital to cover everyday costs and inventory purchase. These needs are partially covered by short-term loans. Short-term loans should be paid back in full, in duration of less than 12 months. Long-term loans. Long-term loans should be repaid in duration of more than 12 months. Long-term loans are usually used for long-term projects, such as construction of new service outlet, or purchase of some fixed asset. Own capital and retained earnings. Capital are resources invested by business owners. Capital can take many physical forms, from cash to physical objects. Capital may take various kind of legal forms too. Retained earnings is profit from dealer operating activities. That profit is not ejected from the business by owners. Instead, it is reinvested into dealer business. If dealer generate losses over long period of time, this section of balance sheet shows retained losses instead of earnings. Both capital and retained earnings are parts of dealer balance sheet section called owner's equity.